So I'm going to start by introducing my fellow panellists, and as I warned them, I'm not necessarily going to stick to the script, so they may be a little bit surprised by the first questions. What I'd also like to do is make sure that we have time to come to you for some questions. So I'll come out, and if you note down anything that you might want to quiz our panellists on, then please feel free to ask whatever questions you like. So to start with, I've got John Purcell. John is from CPA Australia, and he's the Policy Advisor Corporate Regulation. Sandra Rapaccioli. Sandra is the Head of Sustainability at the Chartered Institute of Management Accountants. Richard Spencer, and Richard is also Head of Sustainability, but at the Institute of Chartered Accountants of England and Wales, although with membership more broadly. And finally, Stephen Lang, who is partner in Ernst & Young. And I'm delighted to say that quite a few of the panellists are also some of the members of Accounting for Sustainability. We have a global network of accounting institutes and work with the Accounting and Finance Institute. So I might be asking them one or two questions about what they're doing for their commitments to us as well. I think to start with, we've had a few examples there in that fantastic introduction from Warren about what a mother asked in terms of coming to the conference, what a wife's comments. Stephen, maybe I could come to you first just to say what question, who you asked about the conference and why particularly a topic like integrated reporting, accounting might be important.
Thank you, Jessica. First of all, thank you to the Responsible Business Forum and Teague for inviting me to take part in the panel. I think with any discussion on natural capital, there are two truths that need to be reinforced. One, the way we're living, the way we're running our societies, the way we're running our companies, completely incompatible with the laws of ecology. Ultimately, ecology will win, so we have a choice. We either urgently reframe business within the laws of ecology, or we put ourselves out of business as a species. I think this is very simple. And to test that hypothesis, I thought I'd try and explain to my children over the weekend how the world works and to get their ideas on how they might fix it. But I wanted to see if they understood it. So dragged them away from Guitar Hero 5 reluctantly and said, I'm going to explain the state of the world to you. They understood it very quickly. And they came up with a string of suggestions on what we could do. My kids are 9, 12 and 13, by the way. They said, stop extracting so many resources, invent ways to reuse things so that we extract less, ban companies that don't look after nature, consume less and stop companies making so much money because making money doesn't make you happy. Two things really struck a chord with me regarding communication. They said, well, Dad, if you explain to people what's happening, then they'll change. And then that was qualified, and they said, well, even if they don't believe you at first, when something bad happens in nature, then they'll change. Yet we don't. But I thought that was just a startling kind of insight from children. You know, this is quite straightforward stuff. And my great hope for integrated reporting is that it's a lightning rod for that change. A lightning rod for massive redirection of financial capital into solutions to the problem. So yeah, insight from children, often quite important.
Great. Well, let's see if the rest of you can compete in terms of Steve's children's insights on what we need to do. So we're going to talk a little bit first about integrated reporting as a whole and then dig down a little bit more in some of the developments on natural capital accounting. So, Sandra, maybe I can start with you, just to touch on briefly what integrated reporting is, how it's relevant to the discussions. We had Marcus's comments on information underpinning efficient capital markets. Integrated reporting clearly has the opportunity to help achieve that. Johannesburg Stock Exchange has already made integrated reporting mandatory. It's starting to really get adopted around the world. But what is it?
Well, CIMA wholeheartedly support integrated reporting. We believe it's the future of reporting. And basically what an integrated report does is provide a true picture of how the business creates value. And at the heart of an integrated report is a company's business model. So how does it create value? So a company has a series of inputs. So that includes financial capital, natural capital. There are 6 capitals in total. Then an organisation takes those inputs and has value-adding activities. Then it has outputs, so products and services, and outcomes, which are sort of like the impacts that we're talking about here. So some of the outcomes would be a depletion of natural capital or an increase in financial capital, for example. So getting organisations to think about their business in that way, what their dependencies are and what their impacts are is essential, really. And another element of integrated reporting is looking at the external environment that a company operates in. So they're not just a silo, they're part of a much wider system. And looking at the risks and opportunities represented by the external environment is critical. You know, as we know here, one of the key reasons that companies fail is because they don't spot external colossal changes. And what bigger change really is coming our way than the impacts of climate change and resource depletion and what that means for companies and how they produce their goods and services.
John, just picking up on some of the points that Sandra said, I think one question that I certainly always get asked is around, I get integrated reporting, I get why it's relevant, why it's important, but I'm asked to do IFRS, financial reporting, I'm asked to do GRI reporting, then there's a whole load of different standards and metrics that I'm asked to report against. Why another? How does it fit in?
There's a couple of critical issues here, continue what Sandra's explaining. It is an evolutionary process in corporate reporting. What we are seeking to do is create transformational change in the architecture of corporate disclosure. There has not been to date a concerted attempt to develop a coherent structure of corporate reporting that looks at business model and how value is created and depleted. Now, we do clearly have a present state of significant fragmentation, disconnect in the total landscape of corporate disclosure. Much of what we have still will continue quite clearly as necessary underpinnings to integrated reporting. What ought to be clearly understood with any sort of reporting regime, there is start-up. Once created, once started, you then have a framework which continues year on year. Now, quite clearly, a lot of the debate which is taking place at a number of national levels, so if you ask us to do this extra reporting, what is that we don't have to do? What really you are actually achieving is more clarity, purpose and objective in your corporate disclosure. And then you understand how, say, for example, sustainability reporting, GRI type reporting, interreacts with integrated reporting, and the same with natural capital accounting. We are going through necessary transformation, though at the end the outcome is going to be better reporting and more better disclosure to capital markets.
Yeah. And maybe just to build on that, the International Integrated Reporting Council brings together all of the different organisations that are involved in the reporting landscape. So potentially provides that opportunity or that hope for companies and others for
we'll have a continuing period of disconnect. I mean, there's developments in the USA, the Sustainability Accounting Standards Board, which are taking a far more sector-specific industry focus, whereas others have taken a more neutral approach.
Stephen, maybe I can come back to you just to ask you about the practical side of things. So I know you've been working with companies to help them move towards integrated reporting.
Yep.
And, you know, again, that question of lovely concept, how do you actually do it in practice?
Yeah, sure. I mean,
we could touch on that.
Yeah, I can do. We did some work with the Crown Estate, who issued their first integrated report several months ago. And if you haven't seen it, it's worth looking at the report to see how these concepts of articulation of the business model come through. But in terms of the experience that the Crown Estate had, when they started out, I think the initial starting point was, this is about merging a sustainability report with a set of financial accounts. They very quickly realised that this is about asking a much more fundamental question about how does this business create value in the long term. And they took their time to get that question right, because most board members would have quite a different view of that. And I think most businesses actually, if you really challenge the individuals on a board as to how they articulate how the business creates value, would have a very different response. And that's a really critical first step, to spend time. And so they spent time doing that. They got that quite clear. I think some of the other, I guess, benefits, I mean, they have also used this to streamline their reporting. They took the decision not to issue certain other reports, such as GRI, so they're deliberately trying to focus the communications and reduce the clutter so that it's clear to their stakeholders how they're reporting. And they've also taken away the standalone sustainability report. They've found that it's galvanised the business around a much stronger purpose, so that it's really served to kind of unite people around a clear purpose for the business. It's helped attract talent, and they will say it's really energized the organisation. But I think the one takeaway would be spending time on that fundamental question about how the business creates value. That took them a lot longer than they thought it was going to.
And that certainly sounds comparable to others. I know that HSBC, Unilever, other of the IRC's pilot companies, of which there's more than 100, have said very similar things, that the first question is, what is the business model? And amazingly, for large corporates, that was a question that they didn't necessarily have a common response to. So actually really help them internally, rather than necessarily this being about external disclosure. Of the pilot companies within Singapore, DBS Bank are one of them, and the financial sector is one of the groups of sectors that is the largest percentage within the pilot programme, which is maybe quite interesting when you ask the questions about the different types of impact. Now, of course, as Sandra mentioned, the framework talks about 6 capitals, so very much social, relationship capital, as well as natural capital and financial innovation, other areas, as being fundamental to success. Richard, now you're a former banker. Just coming to you, why do you think that for the financial services sector, this is a concept that is really getting traction?
Well, it's getting traction gradually. I think one of the things that's really helped push it forward is the Natural Capital Declaration that UNEP, FI and Global Canopy Cover pushed about the time of Rio. And I think for the financial services sector, it's a little bit difficult because they aren't on the front line of impact, but they are increasingly recognising that their lending decisions will have an impact on those companies. And so for many of those, it's how do we build that into our lending decisions, and we have already the Equator Principles. And you can see how that translates into project financing, but it's a bit more difficult when you are providing general finance to an organisation, say through a commercial paper programme. How do you start building environmental issues into that. And I know that there's some great organisations like National Australia Bank who are leading some of the thinking around that. I think also for financial institutions, it's probably also thinking about what is the impact that nature will have on them. So that if you have a big lending programme and you're lending to a sector that says exposed to water scarcity, what happens to your portfolio of loans if suddenly water runs out in a particular area where your companies are exposed? So I think what the financial sector has is we often talk about the financial sector and the real economy. And that's just, I think, a kind of myth. The real economy, the financial services, is vitally important to the success of the real economy. And in as far as the real economy is impacted, financial services has this immense power to act and drive change.
So just pausing there, are there any immediate questions from the audience on integrated reporting that you want to put to the panel at this stage? And then we're going to talk through a little bit more detail of some of the role of the accountants and natural capital. But let's pause. Any questions? One in the middle there. And the microphone's just coming to you.
Yes, my name is Ingo Pohl. I work for South Pole Carbon, traditionally a project developer of carbon credit projects. I would like to know from you, we were very successful, I think, when we came up with carbon trading to actually create an environmental asset, carbon credits, right? We also created an environmental liability for companies that were regulated in the emissions trading market in Europe. And for me, this was the first time that an environmental asset has made it actually onto the balance sheet of companies, right? And we achieved this through the full commodification of that asset, right? My question to you, and basically, we basically booked over 1.5 billion carbon credits, like that are now on somebody's books with a value of in the billions, right? We channeled tons of capitals, like estimates around 300 billion, into clean tech because of valuing that externality, right? My question to you is, and maybe before, we are now starting to see other kinds of commodities like water credits, biodiversity credits. But the question to you is, do you see this like full commodification of these externalities as a promising approach for this larger agenda of getting natural capital into financial consideration? Thank you.
Okay, so that picks up on a question of really to monetize or not, and to broaden it out. I think that there was a conference last week in Edinburgh, the first World Forum on Natural Capital, and that was certainly one of the themes that was coming out there. Quite a lot of people feeling that nature is priceless, but not necessarily worthless. So unless it's given a price, will it remain worthless in terms of financial decisions? So who wants to come back on that first, Richard?
I will, yeah. I think the principle of monetisation sits at the very heart of all of this, because there is a very strong argument which is that unless you can do this, how can you start to take account of it? How can you know the value rather than the price? And I think that's an important distinction of what you're doing unless you can put a figure to it. It's also the language of business. But there is a very strong, particularly amongst civil society groups and society as a whole, view that putting a price on nature opens it up to be sold and privatised. Now, we would be arrogant and stupid to dismiss that as the railings of a small minority, because I think what really is being said there is that the people outside, the ordinary people, the indigenous communities and other peoples, don't trust us yet to be good custodians of the natural environment, nor do they trust policymakers or governments. So there's an exercise that business needs to take part in, which is to build the trust of ordinary people that we're not going to squander this resource, because we don't have a great record on preserving the natural environment, and other forms of capital in other sectors we've recent years been particularly good at squandering. So it's a massive point. And I think there's another point to monetisation, which is in pursuing a single value for nature or for an ecosystem or so on, you start to need to leave things out, not because they're necessarily relevant or not material, but because they cannot be valued. How do you value the complexity of an ecosystem? And so that you can paradoxically, and I'm simplified to make the point, you can get to the point where you've got a price or you've got a value for nature that excludes everything you find valuable about nature. So there are these dilemmas that we need to manage and think through in order to make this work. But I do think the monetisation is right at the heart of this debate.
Can I add to that?
Yeah, John.
It's one of the critical points to understand is that the interaction, there is an interaction between natural capital accounting and financial accounting. They're not entirely separate streams. So once you build an understanding around natural capital accounting, it gives you insight into such areas as the carrying value of assets. So better understanding of environmental natural impacts can, through fair value accounting and asset impairment, compel you to look at the carrying amount of your physical assets.
Steve, maybe coming to you next. Certainly the Minister yesterday didn't give much hope coming out of the climate negotiations in terms of really putting the right price on carbon. So if we are going to use market mechanisms and real prices, is there something that can be done in the absence of putting the true social cost on something? There are quite a lot of companies that have been experimenting with this. So as Stephanie mentioned, Puma is one of the ones that has really been trying to price their whole value chain and come up with their environmental profit and loss. Other companies like AkzoNobel have been doing similar kind of work and actually see it as a drive for innovation. So why are those companies doing it if there isn't a real price attached?
Well, I think they're in the striking minority is the most concerning thing. The value chains of the top 1,000 companies are estimated to account for over 60% of the negative environmental impacts. How many of those companies are actually telling the story of their full environmental and social impact? Hardly any. Now, I think the question of pricing and around accounting methods and monetisation, I have a slight concern, although it's an important debate, that we can get lost in discussions about complexity of different mechanisms, and that could sidetrack the debate. I think the really important point is that businesses need to start telling investors about some often uncomfortable truths about natural capital dependencies. The data exists to do that, the tools exist, the methods exist, and largely it's in the narrative and how that story is told. So to my mind, we need to move urgently to tell that story, and investors need to send a signal that it's okay for businesses to tell that story. So, whether it's priced or how it's accounted for, to my mind, is a secondary question. We need collective will to tell that story, ideally through an integrated report.
Sandra, what would you see the role of accountants being? Certainly, I see one or two companies starting to create some interesting roles that are really linking the role of the finance function with understanding of environmental issues. So one, Danone, has created a finance nature team, which really brings together those two to really see how they can advance their thinking in this area. Do you think that's a trend that's going to grow and continue?
Absolutely. I think that dealing with natural capital depletion, climate change requires a transdisciplinary approach. From the accountant's point of view, ultimately what our members do to really simplify things is they provide the right information to help make the right decisions, and that's not just financial information, that's obviously non-financial information as well, costing up risks, potential risks that arise from natural capital issues and challenges as well. So yeah, they have a key role to provide information, and I guess finance people can provide the rigour that perhaps had been lacking in the last few years when managing sustainability information. They can also provide the right analysis and again use their financial mindset and apply that to this new area of challenges. And I think they've got a really important role as integrators as well within the organisation, because they act as finance business partners and navigators, let's call it, to the different business decisions, and they have an overarching view of the company, and they try and link what's happening at a department level to strategy. They have a really important role to help integrate natural capital considerations into processes. So, for example, business cases or capital expenditure decision making. They've got a key role in integrating sustainability information into systems as well. So try to incorporate non-financial information into financial systems. So I think they can really help integrate and pull that information more into decision making and company processes.
And maybe one for John and then Sandra and Richard. You've all part of the A4S accounting network, and as part of that, or your institutes have all signed up to integrating accounting for sustainability into your qualifications, on the basis that should Steve's children follow him in the path of accounting, the qualifications that they receive will have these kind of issues really embedded in the heart of their training. So we're not going to get there unless everyone has the skills and the capacity to be able to understand the issues and respond. So sort of quick answer, to what extent would you say 1 to 5 that the qualifications from CPA Australia are really integrating these issues?
I'm confident to say, boss is not here.
It's not being recorded.
We'll go with 3 out of 5.
Yeah.
There's an interesting question from the audience yesterday about the role of business schools and the university sectors. And this really connects in with what the profession's doing. It is a continuum of education, and we're all about making accountants ready and right for practice and to be adaptable.
Sandra?
I'd say 3 out of 5 as well.
A bit of a theme growing here.
We're
They're not going to say
there.
anything different. They're competing with one another.
I mean, we update our syllabus every 5 years, and actually our new syllabus is being launched in February. So it was a really good time to integrate some of the new thinking around sustainability, and the new syllabus will include integrated reporting, the principles of that, and a lot more issues to do with, environmental audit and environmental risk management, that sort of thing will be in our syllabus. But there's more we can do, but also it's quite tricky as well for us, because when we are developing the syllabus, we speak to employers globally. So, for example, for this update, we spoke face-to-face to about 1,000 employers globally, and surveyed an additional 3,000 employers. And so we need to be led as well by what they're saying they need from their finance teams. And because thinking is still quite traditional, and there are certain requirements that finance people still need to fulfill, that thinking is still there. So we can't quite let go of the old school thinking and the old way of doing things, but we're gradually trying to integrate the new thinking as well, because we know that it's becoming a more important issue, even if some employers might not be there yet.
It's like,
so a bit like the point earlier on customer demand. You're trying to do what you can to shape that demand, but you have to respond to it.
Push at the boundaries as well, and deal with the known unknowns.
Richard?
What they said. 5
out of 5.
I think the key thing, there's an important thing is, look, we are not in the business of qualifying sustainability experts. We're in the business of qualifying accountants. And it's important that sustainability is on their radar, that they know what it is. But you're never going to expect the finance director to be the sustainability manager, but that finance director should ensure that the sustainability process is in place. In what we do when we qualify accountants, we kind of provide three things. There's the skill set, there's experience, and there's knowledge. Now, knowledge is content, and that goes out of date very quickly, if you like. So what we really provide our members with is a skill set, an accountant skill set about scepticism, strategy, critical thinking, all those kinds of things. So quite often it's very important that we build sustainability into the continuing professional development of our members. And I think that's where, I mean, like both my colleagues here, we have ensured that sustainability is built into our qualification in all the right places. We've taken the view that we shouldn't have a separate sustainability paper because that marks it out as separate and different and other, and it's not. It's a mainstream business issue. So it appears like all the other business issues, depending on the questions and so on. But I think it's up to us to make sure that our members are kind of current on this issue, and we're pushing that through the CPD.
I'm going to come back to you in a minute, John. Steve, you're one of the clients, so you are a customer.
Yeah.
How much of a pull are you giving to the institutes to really embed this in their training?
That's a really good question. I think my main point would be we urgently need more ecological literacy underpinning all business school qualifications or finance qualifications, because the vast majority of them are currently based on outdated assumptions. WWF, I see here, they actually run an MBA course with the University of Exeter called the One Planet MBA that has taken ecological principles, and that's the foundation of all of their teaching. They really struggled to get that accepted as an official MBA because it didn't teach the traditional MBA. Anyway, slight aside, but that represents some of the difficulty. In terms of what we're doing, interestingly, actually, Sandra and I have been drafting a paper recently about how the accounting profession needs to step up and change and embrace these issues and embrace these challenges and respond really and innovate within the profession to generate measurement solutions or reporting solutions. There's a responsibility that the profession has. So it's one small example of what we're doing to sort of stimulate the debate.
Any other questions from the audience? So one here at the left and then on the other side. There is one just coming towards you in a sec.
Hi, my name is Johannes Ebeling. I work for Biocarbon. That's a land-based carbon reduction project investor set up by Macquarie Bank originally. We invest obviously in one part of natural capital, which is emissions reductions of greenhouse gases, particularly in the land use sector with a focus on forest conservation. And so in one way that would fit in very nicely into natural capital accounting for a lot of institutions. On the other hand, we've seen, like I'm sure our colleagues at South Pole have, that carbon offsetting or carbon management that includes real expenditure is seen as a discretionary expenditure, increasingly since the global financial crisis. And so I'm curious, in your experience, is that simply an accounting and a reporting exercise? Or to what extent do companies at a board level actually take that seriously as a decision metrics? And to what extent do things like carbon emissions, but also the product value chain, incorporate those kind of metrics really as a decision tool? One of our projects, for example, works with Brazil nut production. And one thing I didn't know about those is that they actually only grow in natural forests. So that project helps small-scale concessionaires to maintain the forests and adds value add, brings the Brazil nuts to an export quality standard, and that would be a fantastic product to integrate into supply chains and have a whole host of benefits associated with that. But I'm not sure to what extent companies really do take that seriously beyond CSR and beyond discretionary expenditure. Thank you.
Okay, so is it just a fig leaf, or does it hit the board level decisions and other decisions? Who wants to pick that one up?
I might just touch on product.
Stu? Yeah.
I might just touch on product. I'm actually quite encouraged by how much work and effort is going into understanding impacts at the product design level. I think there's a lot more happening there than at the external reporting end. So I think companies are starting to take that quite seriously. They are factoring that into their decisions. Not all of them, but there's definite strong momentum there. And that's stimulating quite a lot of supply chain innovation and collaboration. So I'm actually quite encouraged in that aspect, at least.
Sandra, maybe around integrated reporting, are you seeing that as a way that some of these factors are getting onto the board table?
Yeah, I mean, definitely looking at the business model and the inputs that a company needs means that is being increasingly, well, that information is being increasingly presented to boards. I mean, in a way, an integrated report should just be the top slice of management information, so that information should be discussed regularly at board meetings. And that's why I think having the finance person on board and quite integrated in this agenda is helpful, because obviously they prepare the papers for the board. But there's definitely more that needs to be done. I think the language that's used when communicating with the board could be improved. For example, talking in terms of CO2 emissions, in terms of tonnes or cubic metres of water, doesn't really mean much to many board members, particularly if no benchmark is provided. So that's why monetisation can be quite a useful way of getting people's attention. However, with monetisation, I think it was A4S research that found that if there isn't a true market value, CFOs in particular don't necessarily trust that information. So it's a fine line. It's using business language to communicate, I guess, the risks and impacts from environmental and social issues, and perhaps quantifying those in some way. But sometimes monetisation isn't necessarily the best way to present something or talk about the issue.
Yeah. And then we had another question over here. And whilst the mic's going over, maybe one other example of that, the IRC did some research during the first year of the pilot programme, and quite a startling 95% of the companies in that pilot programme felt that really bringing together a different information set, asking these questions, was helping them to get issues onto the board table and make that link to risk. So I think where you can link it to the business as a whole, that really drives progress. Similarly, AkzoNobel, which Stephanie mentioned as an example, when they looked at their value chain, they found as many businesses, it was outside their normal operations, and that has led them to really innovate on new products. So, for example, around paint, anti-fouling paint, which saves the shipping industry where they sell their paint to, I think it's something like 8-10% of energy costs. So, incentive to buy their products, saving impact up and down the carbon chain. So I think it probably depends how it's done. On that said, I'd have said the vast majority of companies are still having a sustainability team that does great work but doesn't necessarily permeate the rest of the organisation. Question over here.
Hi, Anne Florini from Singapore Management University. This isn't a very well-formed question, but it was inspired by what Richard said about monetization and also the perils of monetization, and combining that with something that Magnus Bacher said this morning, this homage to the idea that the primary responsibility of business is to make money. There's an enormous problem of lack of trust in business, and in all institutions, but particularly in business right now. This did not used to be the case in Asia to the degree that it is now, but the recent findings of the Edelman Trust Barometer in Asia are a pretty striking fall in trust in business, even within Asia. I'm wondering how you reconcile the notion of monetization, integrated reporting, speaking the language of business as though that language has primacy over other values, is compatible with the idea of rebuilding trust in business. How do we put those pieces together?
Great question. John, You haven't been speaking very much recently. One for you.
Certainly there is a significant role ahead for business to re-establish trust. A lot of what we're seeking to do is improve levels of transparency. There's, however, frictions involved. The more transparent an organisation seeks to be, the more it starts to deal with disclosures which are future-oriented in nature. And then you come up with then conflict internally within organisations. Well, we don't wish to disclose information which gives away competitive advantage or exposes the company and its directors to liability. There is a significant amount of work to be done. I think we underestimate the strength and the quality of a good reporting regime. A good reporting regime is not really the end product. Reporting actually is a reflection of what happens internally inside an organisation. If we can reorientate our disclosure mechanisms, then we are more likely to see and drive changed behaviour. I don't think we're going to see immediate transformation, and we need critical mass and we need experimentation, and I think we need the trust of markets as we develop.
So Professor Mervyn King talks about radical transparency as being one of the trends as really helping to address that question of trust and really that businesses can't necessarily hide and therefore really need to embrace transparency and respond. Maybe coming to one of the other, any other thoughts, Steve?
Yeah, I think it's a great question. Jessica, you'd mentioned the World Forum in Edinburgh last week. There were protests outside the World Forum about precisely this point. You know, how dare you put a value on nature? How dare you talk about it in terms of monetisation or commodification? They had a meeting. The organisation was called Not for Sale. They had a protest meeting in the evening. I actually went along to that meeting to understand, or try and understand their perspectives. And the gulf and the lack of trust is enormous. And they will talk about the business community in terms of they are the evil people that are trying to now monetize and take over in this sort of language. So it's a significant problem. I think the only solution is meaningful, it sounds cliche, but it's meaningful stakeholder engagement. It's bringing civil society and those with dissenting voices into these discussions about how should corporates communicate what they're doing, because lots of the language is frankly impenetrable to most people. So I think that really needs to be addressed, and that only really comes through better stakeholder communication. I think as Ron from ABB said yesterday, constant listening about different perspectives and not assuming that the right way to do this is business's traditional ways of reporting and communicating.
I think we've got time for one more question. One first hand was up at the back, and I believe you have a microphone, so perfect.
Yeah. I'm Candice Chong from Imaco Enterprise, Singapore. I'm a mother. I'm so glad that I heard from Stephen what your children have asked you and the sort of questions and answers that he has given. I thought about it the whole night, and I slept at 3 o'clock. I brought out a cane which my mother used to discipline us. We have done a lot of mistakes. Whether you are the entrepreneur, you are the businessman, you are the children, or you are the mother, you are consumers. The Mother Earth has not given you a bill, so you have to pay it. You might not be paying it this generation, but your next generation will pay for it. I cane my children to tell them, stop making that same silly mistakes. 3 canes. No flesh, the cane will not go back. So, our Mother Earth is telling us, let's do something right. The top 1,000 companies control the 60% of the wealth. So, how much money do we want to make us happy? I think Ernst Young company knows the numbers. So I think Mother Earth will send us a bill. But I also want to know how much can we cut back and we step back and think carefully. Do we want so much more? Do we want more houses, bigger assets, or we want more digits in our bank account to be happy? I think all of us want to live long. We want to have our next children enjoying the same life that we have. So I really thank Steve for bringing this up and give us a number, how much we have to cut back to put in our bank to save for our Mother Earth, for her to recuperate, for her to have a better life, for her not to bleed and suffer. Yeah. Thank you.
Okay, so how are we going to meet that challenge?
The
Richard.
challenge of the earth.
How do you make the numbers add up?
Yeah, well, I mean, one of the first things we could do is stop wasting so much. You know, we say, how are we going to feed a third more people? Well, you could stop throwing away a third of all the food we produce. Be a good one. Eat less. And actually things like, you know, we've seen huge steps in things like the sharing economy. What's at the centre of everything we're talking about today is to stop doing what we're doing the way we're doing it and trying to do it better, but change the way we do things. So, you know, and this is where some of the trust in business will happen. When people see businesses actually saying, the environmental limits we're facing are what matters. What is the business model that delivers on that? And that's something that we have to do personally as well. You know, the enemy lies within each of us to actually, what are we prepared to do less of in order to... Will you go on less holidays? Will you give up that high-performance car? Will you consume less? You know, those are the decisions we make, but we're remarkably reluctant to do so. It's very convenient just to blame business rather than take the responsibility ourselves.
Okay, so final question to each of you. If there's one thing, one takeaway that you and everyone here today can do around this agenda, what is the one thing, the one takeaway that you would give to the audience to help move this forward?
Shall I go?
Stephen, start.
Book your CEOs on a basic ecology course.
John?
I think we need to learn very quickly from experiences of significant corporate failure and not to repeat those lessons when it comes to failures in the environment.
Sandra?
We need to account for the right things, and it's better to be roughly right than precisely wrong.
Last word, Richard.
So I think what we can do personally is go away from here and think about what you could do less of that would make somebody else's life beneficial, and then start to build collaborative networks of people so that you can scale that.
And actually, I'm going to have the final word because I'm the chair. Last night, the Tea for Business IFC coalition was launched. They're starting projects to really look at how you can do this in practice. I'd encourage all of you to think about participating in that programme. Thank you all very much.
Thank you, Jess and the panel.